Hello everyone, welcome back to Financial News. Today is October 3rd, 2022. I'm Paul Munico from Ameriprise is my co-host. I'm Ron Jankowski with Channel 4. Paul, give us an update as to what took place with the market last week.
Thanks, Ron. I am going to lead off with those people at home that have been waiting anxiously for a new or used car and got some updates on that market. So as we know, new and used cars have been in exceptionally short supply the last 2 years as global production has been curtailed by a shortage of parts. Now, this lack of availability has led to sharply higher new and used car prices, prices that have been a key contributor to inflation. Now, a light at the end of the tunnel appears to be building. As seen in data, monthly U.S. auto assembly numbers shown on a seasonally adjusted annualized basis has been growing stronger the last few months, according to the Federal Reserve. Now, August's build rate of 10.5 million units matched that of the prior recent high as seen in April. Now, by comparison, the industry built an average of 11.2 million units per year in the 3 years prior to the pandemic. Build rates will likely need to exceed this prior average to rebuild inventories to adequate levels. But with the improving production numbers, the pace of automobile price appreciation has been slowing as well. In August, new car prices were 10.1% higher year over year, while used car prices were up 7.8%. That according to the Labor Department's Consumer Price Index. Now, undoubtedly, these are still exceptionally strong year-over-year gains, but they represent a notable deceleration from prior year-over-year rates. In March, new car year-over-year price gains peaked at positive 12.6%, while used car prices saw year-over-year rates of greater than 40% as recent as February. And the data, a lot of this data is sourced from FactSet, so you can look into it further if you'd like. But if you're waiting because you couldn't get a car, potentially good news on the way.
But you could probably buy a truck.
Probably buy whatever you want as long as you're willing to pay a premium for it.
Yeah, I see pickup trucks are really becoming dominant in the lots now. They're probably easier to get, but I don't know if it has all the features. The electronics are being short. Maybe they won't warm up your steering wheel, or maybe you don't ever going to. I don't know, but I understand that some of the features are being shorted on some of the vehicles. Well, Ameriprise sent this information in this morning. U.S. stock index futures are higher today after Friday's close that put the S&P 500 down 9.2% for the month.
I mean, we've been down so much, you're just naturally going to get some up days. I don't know what this means yet. We've got to see why it's up and if it holds. Those are the futures. Remember, as I always say, that's not how the market closes. That's how it's predicted to open. So we got to wait and see.
Well, it was the second worst month in 10 years behind March 2020.
It's hard to believe because, you can understand COVID, you can understand the financial crisis. This one is just inflation and other things, of course, but it's been rough.
The markets in Asia closed mixed with Japan up 1%, Hong Kong down 1%. European markets are modestly lower off the recession lows. Treasury yields are lower across the board with a 10-year down to 3.70%.
Those rates have been climbing, so just like the market futures, sometimes just recede back. Right.
WTI crude is up 4% on rumors OPEC Plus may cut production to support prices. Gold is up 0.2%. Bitcoin is down 1.2%. But, OPEC is going to play the game. It's what it looks like to keep the prices up.
Yep.
They see that market being high, they're going to make it short so that the supply and demand is in their favor.
We'll see. I don't know what they'll do, but that's what they're predicting, is what you've
Yeah,
read.
exactly. S&P 500 year-to-date percentage index returns are minus 23%, Dow Jones a minus 19%, NASDAQ a minus 32%
Those are bad
year-to-date.
numbers. I mean, those are really bad. But the key being year to date, and the year is not over. So hopefully we can get these up before the end of the year.
There's not too much time left, but hopefully, yeah, as you say, they could recover. Okay, thank you, Paul, for that update. We will be right back with a program called Your Money. Paul has an excellent topic to share with us. Stay with us. Thank you for staying with us on our show called Your Money. Paul's topic today is worried about stock market. Here's how to reduce your risk. Paul, take it away.
Thanks, Ron. Investment risk during times of market volatility like we're in right now since the start of 2022, it's natural to feel a bit skittish about the stock market. It's a potent reminder that there are risks to stock ownership. Now, individual stocks are not guaranteed to grow and may lose value. We know that. But the good news is that the stock market has historically delivered a higher rate of return than other forms of investment in the same time frame. Now, with this in mind, there are strategies you can deploy to help insulate your portfolio from the natural up and down swings of the market while staying invested for the long term. One strategy is buy and hold. There will always be day-to-day fluctuations in the stock market. Plunging stocks can cause panic selling, and rising stocks can inspire overly optimistic purchasing. A buy and hold investment strategy, it takes a long-term view to investing. It discourages buying or selling stocks in response to market dips and surges. Now, over time, portfolios governed by this strategy, they tend to deliver more robust long-term results than ones guided by emotional decisions. We always talk about asset allocation. It's another strategy that involves holding investments across different asset classes to meet your investment objectives. Asset classes include stocks, bonds, cash, and alternatives. Now, each asset class has a different risk profile and upside potential. How much you assign to each asset class will depend on individual circumstances such as your time horizon, tolerance for risk, need for liquidity, tax situation, and your financial goals. Investors with a longer time horizon usually can tolerate more risk, so will hold a larger percentage of stocks within their portfolio. Investors with a shorter time horizon may hold more bonds or similar instruments that offer greater security with lower yields. Something else we always talk about on this show is portfolio diversification. Now, portfolio diversification is another strategy designed to help you spread risk across your portfolio. It involves selecting a variety of investments within each asset class to help minimize risk. So, for example, by putting your growth stock money into several companies that meet growth criteria, you are protected in the event one of those companies fails. You could consider dollar cost averaging. This investment strategy takes a disciplined approach to purchasing investments. The idea is to purchase more shares of stocks, bonds, and/or mutual funds when prices are low and purchase fewer shares when the prices are high. The principle here is to be systematic in your purchasing. Now, dollar cost averaging over time usually results in lower average cost of shares in your portfolio, creating greater opportunity for profit as share values rise. Lastly, find an ally for your smart investing. Talk with your financial advisor to learn how to implement these and other investment strategies to help your investment portfolio. And as with all investments, past performance does not guarantee future results, and no investment strategy is guaranteed to be profitable or help you avoid losses. Common sense and a balanced approach tend to be your best strategy sometimes to win at the end of the day.
You know what's important basically is getting guidance from a financial advisor and maintaining that discipline. Once that strategy is put in place.
Yep, you got to first develop the strategy, but then you said the key word there being discipline. You know, we get in markets like this, it's very easy to get caught up in the emotional downswing of the market, and this will turn, and then the emotional upswing of the market. You need that discipline, which oftentimes an advisor can help you with.
Excellent. Paul, if one has a question, can they call you?
Absolutely. You can call me directly at 708-226-3412.
Thank you, Paul. From Ameriprise Financial. We appreciate your input today. For Paul Munichel and myself, Ron Jankowski with Channel 4, we wish you good investment.
Downswing of the market. Discipline will turn, and then the emotional upswing of the market. You need that, which oftentimes an advisor can help.
Excellent. Paul, if one has a question. From Paul Financial.
Downswing of the market. Discipline will turn, and then the emotional upswing of the market. You need that, which oftentimes an advisor can help.
Excellent. Paul, if one has a question. From Paul Financial.